Since the start of the year, because of Trump's protectionistic policies and his tariffs, the US dollar index has fallen over 10% against major currencies. So whenever the dollar weakens, you get a lot of these like headlines in the media where they say that it's de-dollarisation, people are moving away from the dollar is collapsing and is going to be replaced as a global reserve currency, and creates a lot of fear in people who are holding US dollars and US dollar assets. So as you guys know, about half my net worth is in US dollars and is in US stocks and bonds. So is this something I'm concerned about, and what am I going to do about it? I'm going to share my thoughts in this video. Here are some recent news headlines about the dollar. Morgan Stanley's dim US dollar outlook gets darker as economic risk mount. Warren Buffett's crystal ball says that the US dollar is headed for a collapse amid global currency shift. So how true is this? Or are these merely sensational news headlines? Well, that's where you got to do your research to cut through the bullshit. Let's begin by looking at the US dollar index, ticker symbol DXY. This is the US dollar against a basket of the major currencies. So it is true that year to date, it is down. It's been down over 10% year to date because of, again, the tariffs and Trump's policies. But it's since rebounded slightly, so it's down about 7.9% year to date. So is it a collapse of the US dollar that is going to go to zero? It's going to get worse? Well, we got to look at a different time frame and not just judge from one short-term time frame. So let's zoom out and let's take a look at the last 5-year time frame on the US dollar index. And you see a different picture. So what you see here is that, 5 years ago, the US dollar index was at this level. And right now, after the 10% drop, it is right here. So it's basically flat for the last 5 years. And if you take a look at the last 3 years, notice that it is in what we call a range, where it's got a what we call a support level over there, right? And it's got kind of like a resistance level over there. So it's kind of in this range here. Now, if you look at the price action, what does this look like? If you have taken the price action manipulation course by Adam Khoo, you know that this is called a false bottom pattern, or simply called a bear trap pattern, where price makes a low, goes up, and then goes down, makes a lower low to force out the stop losses, and closes above that previous swing low. So purely based on the price action, now again, no one can predict the future exactly. No one can predict exactly what's going to happen. But purely based on price action, this is what we call a double bottom or bear trap pattern. So if I were to take a trade on the US dollar, would I take a long trade or a short trade? I would rather take a long trade, because based on this, I think the probability of the US dollar rebounding, at least in the short term, is higher than it actually going down. Again, this is purely based on price action. It is not a guarantee and not a 100% prediction. Now, if you take a look at the longer term chart of the US dollar index, let's go back, to the 10 to 15 year chart, which is a longer term chart, and you can see a longer term trend that emerges. Okay, so if you take a look at the last 15 years, what do you notice now? Is the US dollar index on a decline, on a collapse? Not really, right? In fact, you can see that it is on an uptrend and continues to be on an uptrend. You can see that 15 years ago, US dollar index was here. Right now it is here, even after the 10% drop, but it's very much a lot higher than where it was. In fact, it's up about 29% against all the major currencies over the last 15 years. Over the last 10 years, it's also up double digits. And you can see that on an uptrend, it goes through these wave patterns as usual, right? Wave up, wave down, 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 wave up, wave down. So sure, it could even, in fact, test this support level. There's a very long-term trending support level. It could still go lower here. That's also possible. And then bounce off before heading higher, all right? So that's also a possibility. But again, we do have a bear trap pattern here, so it may rebound here as well. But the point to bear in mind is that the overall longer term trend of the US dollar versus, again, major currencies is actually up, not down. So you got to look at the charts. Now, let's break it down to individual currencies. So on this chart over here, you can see I've plotted the US dollar against the major global currencies like the Indian rupee, INR, the Japanese yen, JPY, Australian dollar, AUD, Canadian dollar, CAD, British pound sterling, GBP, the euro, EUR, the Chinese yuan or renminbi, the Singapore dollar, and the Swiss franc. And this is over a 15-year period from 2010 to 2025. So what's the first thing that you notice? The first thing is that the US dollar actually appreciates against all the major currencies except two currencies, the Singapore dollar and the Swiss franc. So the US dollar has appreciated against the Indian rupee by 82.49%. This is again US dollar versus Indian rupee. US dollar appreciated 63% against the Japanese yen. It has appreciated 35% against the Australian dollar, appreciated 34% against the Canadian dollar, appreciated 13% against the British pound, appreciated 10.4% against the euro, and appreciated 6.39% against the Chinese yuan. Said another way, the Indian rupee depreciated 82% against the US dollar. So among all the global currencies, the Indian rupee is the weakest currency in the world, all right? And the Chinese yuan depreciated 6.39% against the US dollar. So all these currencies that you see in green depreciate against the US dollar. So if I'm from any of these countries, if I'm from India, I'm from Japan, I'm from Australia, I'm from Canada, I'm from the UK, guess what? I would rather hold US dollars than my own local currency. But of course, I still have to hold my own local currency to pay for expenses, right? But when it comes to saving my money or investing my money, then being invested in US assets is a double bonus. Not only do I get higher gains from US stocks, but I get a bonus of currency gains against my local currency. Now, but what if I live in Singapore, which I do, or I live in Switzerland, okay? Now that's a different story. So you can see that these are the only two currencies that appreciate against the US dollar, or rather the US dollar depreciates against the Singapore dollar and the Swiss franc in the last 10, 15 years. So in the last 15 years, the US dollar has depreciated 6.36% against the Singapore dollar and depreciated 23% against the Swiss franc. Now, then some of you be saying, but Adam, so you live in Singapore, and so that means that if you hold US dollars, your US dollars are losing value against your Singapore dollars by 6.36% in 15 years. Isn't that not a good thing? Yes, but I still prefer to hold US dollar cash than Singapore dollar cash. Let me say, why? Well, let me explain. So first of all, you can see that in 15 years, the US dollar has depreciated 6.36% against the Singapore dollar, right? So how much is that a year in depreciation? Well, let me go to my financial calculator, my Piranha Profits financial calculator, and you can see I put in 15 years, and from 100 base, the Sing dollar appreciates 6.36% against the US dollar, all right? So how much is that annually? Well, I click solve, and that is 0.41% annually. So that means that the US dollar depreciates against the Sing dollar by 0.41% a year, or said another way, the Singapore dollar appreciates against the US dollar by 0.41% annually. Now, here's the thing that most people don't understand. For my US dollar cash, I'm getting a much higher interest rate than my Singapore dollar cash. So even if the currency loss of the US dollars, I'm still making more money holding my cash in US dollars. So let me explain. So my US dollar cash, what do I do with it? All right. So I use it to buy US Treasury bills through Interactive Brokers, or you can buy it through any broker. I also use it to buy US bond ETFs like the SGOV. So for short-term bond ETFs as well as the short-term Treasury bills in the US, I'm getting about 4% interest rate a year. Okay, so let me write this down. For my US dollar cash, I'm getting a 4% interest rate per year. However, for my Singapore dollar cash, if I put it into fixed deposit, I'm only getting about 2% a year. Even if I put into Singapore government bonds with a 12-month maturity, I'm getting about, at the most, 2.5% interest rate a year. So, which is a better deal? Again, if I put my money in US dollars, I'm getting 4%, but I'm losing 0.41% a year in currency loss. So what's 4% minus 0.41%? Net for my US dollars, I'm getting 3.59% after currency loss a year. Whereas for my Singapore dollar cash, I'm getting 2.5% interest on my Singapore dollar cash. So you can see that I'm still getting a much higher return on US dollar cash than Singapore dollar cash. Now, of course, having said that, I don't put all my money, all my cash into US dollars because I live in Singapore. I got to spend Singapore dollars on my expenses. So still about half my cash is in US dollars and half my cash is in Singapore dollars. Now, I hear some of my Singapore friends not wanting to invest in the US stock market because they say, but US stocks, I'm exposed to US dollar currency risk. The US dollar may depreciate against the Singapore dollar. Well, to me, that really doesn't make any sense. And let me explain why. Okay, remember that the most dominant, the most innovative companies in the world are listed in the US. They have got the highest growth in terms of equity returns. So for example, if you invest in the US stock market using, for example, the S&P 500 ETF, which is a passive investing method, and that's called the SPY, you can see that over the last 15 years, your wealth would have grown at 550% return in US dollars. If you invested in the Singapore stock market through the Straits Times Index ETF, ticker symbol ES3 on the Singapore Exchange, your wealth would have grown at 131%. Yeah? Now, again, notice this. If I were to invest, which I did, okay, in the US market, again, the S&P 500, I would have gotten 550.29% return. And again, in the Singapore index, I would have gotten 131.54% return. But because this is in US dollars, I suffer a currency loss of how much? A currency loss of 6.36% over the last 15 years, right? So if you take this minus 6.36% currency loss over that 15-year period. So what do you get? 550 minus 6.36 gives you 543.93%. Again, it's still way higher than investing in the Singapore stock market. So I'm still getting, 543 divided by 131. I'm still getting over 4 times more return in the US markets than the Singapore stock markets, even with the currency loss of the US dollar versus the Singapore dollar. So this is the reason why I continue to invest in US stocks and US bonds, because I know that the returns I get from the US dollar assets far outweigh any kind of currency loss against my local Singapore dollar. Now, of course, if I live in India or I live in Japan, Australia, Canada, or the UK or Europe, then this is not something that I'm even concerned about, because historically, all these currencies depreciate against the US dollar. And moving forward, I don't see any reason why that would change. And someone once asked me, besides Singapore dollars and US dollars, if I had to own another currency, what would it be? And the answer is pretty simple, the Swiss franc, because the Swiss franc, as you can see historically, appreciates the most against the US dollar. Yeah, but well, I hardly travel to Switzerland, although I do go there once in a while, but doesn't really make sense to hold that much Swiss francs anyway. Yeah. So let's answer the second question, which is the US dollar at risk of losing its global reserve currency status? And if it is, then what other currency could potentially replace it? Well, the first thing to understand is, why is the US dollar the global reserve currency? There are a few reasons. Number one, what makes it the global reserve currency is the fact that the US has the biggest economy in the world. The economy is 30.51 trillion US dollars. Number one, it's got the strongest military. Of course, China is fast catching up. And of course, the third thing is the widespread use of the US dollar. It's one of the most liquid currencies used in the world. And it makes up 58% of global foreign exchange reserves. Now, the media has been sounding the alarm that the US dollar has been losing its share of global foreign exchange reserves, which is absolutely true. In fact, many years ago, the US dollar made up like 70% of global FX reserves, and now it's 58%. So it is losing its market share, if you will, of global FX reserves. But the question is, what's the alternative? Which other currency could replace it? And the answer is none. So the point is that, is the US dollar a perfect currency? Of course not. It's got a lot of problems. It loses value like any other currency. And the US has got huge amount of debt. But the point is that there's no other currency that's close to even replacing it. Why? Because now, what's the closest currency with the next highest share of reserves is the euro. And the euro makes up currently 19% of global FX reserves. So it's still very far away from the US dollar. And then even further away will be the Japanese yen that makes up 5.83% of global FX reserves, the British pound 4.98%, and the Chinese renminbi only makes up 2% of global FX reserves. So again, this can keep falling for many, many years to come, but it's still way ahead of any other currency in the world. So again, which currency could replace the US dollar? Let's look at the closest contenders. Now, the first contender would be, of course, the Chinese yen, or the renminbi, known as the CNY, okay? So what are the strengths and weaknesses of the Chinese yen? So the first strength it has, obviously, is the China economy. The Chinese economy is the second biggest in the world at 19.2 trillion US dollars, again behind the US at 30 trillion US dollars, but it's catching up, right? And China's military is the second strongest globally and may overtake the US in years to come. You never know. So that is a strength. And the Chinese yen is increasingly used in trade settlements, especially in Asia. And so those are the strengths. But there are a lot of weaknesses. And the main weakness would be capital controls. What does it mean? Now, as you know, you can easily take US dollars out of the US and into the US. You can't do that with China. For example, I've got close friends, Singaporeans, who have businesses in China, and they have got millions and millions of dollars worth of Chinese yen, and they can't take it out of the country because of capital controls, okay? And there's a lack of full convertibility. What does that mean? So the Chinese yen cannot be freely exchanged for other currencies or used in international transactions without the permission of the Chinese government. So there's a lot of restrictions imposed by the government about how much Chinese yen can leave the country. Okay, so whenever a country doesn't allow its currency to flow freely around the world and their capital controls, it can't be a global reserve currency. Yeah, and the other thing is that you've got a lot of political risk, including centralized control. At the end of the day, China is a communist country. It is not a democracy. And this will deter widespread adoption of its currency. The other thing is Chinese financial markets are also less open and less liquid than the US markets. And again, only 2.19% of global forex reserves are in Chinese yen. So it's very, very far behind. So conclusion, the Chinese yen has a low to moderate chance of appreciating against the US dollar in the next 10 years. But very, very, very unlikely to be able to replace the US dollar as a global reserve currency, at least in the next, 30 to 50 years, right? And again, in the last, this should be 2025, there's a typo here, right? So in the last 15 years, you can see again the Chinese yen actually depreciated against the US dollar by 5.86%, or the US dollar appreciated against the yen by 5.86%. So the overall trend of the US dollar versus the yen is actually going up, which means the US dollar, based on the trend, should continue to appreciate against the renminbi over the long run. Now, the next contender would be the euro. Now, again, what are the strengths of the euro? The eurozone has a pretty large, stable economy at 16 trillion. It's the second most held reserve currency. It makes up 19% of global reserves. And it's widely used in international trade, especially in Europe and Africa, and benefits from the credibility of the European Central Bank. But what's the weakness of the euro? First thing is the eurozone's fragmented fiscal policy and political disunity weakens its global appeal. In other words, the different countries in the eurozone have got different fiscal policies of government spending and interest rates, right? And of course, recently we've got economic stagnation in key member states like Germany and the PIGS, Portugal, Italy, Greece and Spain have high level of debt to GDP ratio. So they themselves are suffering from very high levels of debt. So this reduces confidence in the euro itself. So conclusion, the euro is the most viable alternative to the US dollar, but lacks the unified backing of the member states to displace the US dollar. What's the probability the euro can strengthen against the US dollar in the next 10 years? It's a low probability. So again, you can see in the last, again, this should be 2025, sorry, right? Type in the last 15 years, the US dollar has appreciated 10% against the euro, and based on the current trend, should continue to appreciate against the euro, which means the euro will likely again continue to depreciate against the US dollar, unless of course something catastrophic happens to the US economy, which is unlikely. Next would be the British pound. Is this even a contender? Well, not really. Okay, first of all, what are the strengths of the British pound? It's got historical significance. Many years ago, when policemen wore shorts, there was the British Empire that controlled the world. Not anymore, okay? And of course, the pound is used in global finance, but the problem is that UK's economy is very small compared to US, China, and the Eurozone at only 2.5 trillion. And the sterling pound's limited trading volume makes it a very minor player, and it only accounts for 4.98% of global reserves. So conclusion, the sterling pound is unlikely to challenge the US dollar due to its limited economic base and influence, and low to moderate possibility of the pound strengthening against the dollar in the next 10 years. Again, if you look at the last 15 years, same thing, the US dollar has appreciated against the pound by 11.47%. Of course, because of Brexit, the UK has weakened considerably because of that as well. Okay, the last one, which we can look at, is the Japanese yen. Is it a contender? Well, again, not really. Why? Well, the only strength about the Japanese yen is that it's very stable and it's used a lot in Asia, and it's seen as a safe haven. So whenever there's a conflict, there's wars, people tend to buy the Japanese yen as a flight to safety, like the US dollar. But weakness, the Japanese economy has been going through economic stagnation. It has got the highest debt to GDP ratio in the world, and it's got very low interest rates compared to the rest of the world. So that limits its appeal of people holding Japanese yen. It has significantly depreciated against the US dollar by 61% in the last 15 years. And it only accounts for 5.83% of global FX reserves. So conclusion, very low probability of the Japanese yen strengthening against the US dollar in the next 10 years, and to replace it, no way, Jose. Finally, what about BRICS? A lot of people have been talking about the BRICS currency replacing the US dollar, de-dollarisation. People are going to use the BRICS currency. Now, what's BRICS? BRICS stands for Brazil, Russia, India, China, and South Africa. So first of all, these individual countries, their currencies have depreciated the most against the US dollar. So again, in the last 15 years, the Brazilian real has depreciated 216% against the US dollar. Russia depreciated 171%. India depreciated 80%. China depreciated 6%. South African rand depreciated 33% against the US dollar. So again, this is individually. Now, in 2022, they all got together and said, hey, we're going to come up with a unified currency that's backed by part gold and part currencies of all these member states. Now, since then, the establishment of this currency remains uncertain. There's no confirmed launch date because there are significant hurdles to get it done. Now, if you ask me, I don't think it's ever going to get done. Okay, it's a fantasy, and if it does get done, I don't think it's going to be very successful. Okay, now why? Now think about it. So imagine that you are a Chinese family, okay, and let's say in your Chinese family you have got all your relatives. You have got your mother-in-law, your father-in-law, your dad, your mom, your children, your cousins, right? And imagine all of you decide to share one credit card. Okay, guys, let's all share a credit card. Let's all share a bank account. That's going to be not easy, right? Because you know your brother-in-law may spend more than you, and your dad may make a wrong investment, and that will affect you. That sounds difficult. But let's take it one step further. Let's imagine that you are a Chinese family and your neighbor next door is from India, okay? and you've got another neighbor from Brazil, another neighbor from South Africa, and you all get together and say, hey guys, why don't we all share one credit card and we all share a bank account? And do you think that's going to work? I don't think so, because all of you have different financial habits and you have got different financial backgrounds. So let's imagine that the Indian family is worth billions of dollars. They are, the top richest Indian family, and you are a Chinese family where you're only making 50 grand a year. Do you think it will work if you share a credit card with this billionaire Indian family? I don't think so, right? It's the same thing with all these countries trying to share a unified currency. It's not easy. So the challenge is that creating a unified currency would require establishing a new central bank, which all these countries must agree on. Where do you put it? You put it in Shanghai, in Beijing. Do you put it in Moscow? Where do you put the central bank? They all have to agree, right? There has to be established regulatory frameworks and consensus among these member states. And the problem is that all these member states, China, India, and Russia, they differ significantly in economic and political systems. Where, for example, China is a communist country, whereas India is a democracy, and Russia is a pretend democracy. You vote for the opposition, you get thrown out window. And of course, there are a lot of geopolitical tensions between these member states, where once in a while, China and India, they will fight across the border. Again, imagine your Chinese family, once in a while, you fight with your Indian neighbor and you want to exchange credit cards. Are you insane? Right? And for this to work, they have to have a shared central bank, and they have to have a consensus monetary policy. Can you imagine Russia, India, and China all agreeing on a particular monetary policy and all agreeing to put their central bank in Moscow or in Beijing? It sounds ludicrous, right? So the probability of success of this currency is very, very low if you think of it logically. Even if they can launch it, the widespread adoption beyond the BRICS nations is very uncertain, because major economies like Japan, the EU, and Canada are unlikely to trust a BRICS currency due to concerns over transparency, governance, stability in member states. Again, Russia is being sanctioned by many countries. You have China's capital controls. You can't move the Chinese yen freely. You got a lot of issues. So long story short, is the US dollar a great currency? No, it sucks. But all currencies suck. It's just that US dollar sucks less than most other currencies. But ultimately, remember, whatever currency you hold, whatever cash you hold, it's going to lose value every day because of inflation. So the only way to hedge inflation and devaluation of currencies is to own productive assets. And the productive assets that gives you the best hedge, in my opinion, would be owning great businesses or great equities around the world. Okay, so hope this has been useful. This is Adam Khoo, and as always, may the markets be with you. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.